Well, first, thanks for having me. I think, now that we actually see the market start to price in even a bit more than three rate hikes this year, but I think we have to take a step back and remember that these minutes are from the meeting from last month in December. This isn't fresh thinking from the Fed in light of the impact that Omicron has had. We don't have any more information about what the Fed's thinking than we did several weeks ago. I think at that time, what we understood was the Fed, on average, expected to raise rates three times in 2022. I don't think anything about that outlook has changed, or they've gotten incrementally more hawkish since then. But I do think that maybe investors are now focusing, now that we're in the new year, are focusing more on that. We didn't see that much of a reaction after the meeting itself. We're seeing one now in terms of the steeper yield curve, a little bit of a stronger dollar, but I think just lingering concerns about the Fed maybe starting to move a little bit too quickly in shrinking its balance sheet and in over tightening this year. And if those concerns creep in, and right now I think they're concerns, not alarm, you could see valuations pressured across the board in the equity market, which would tend to favor lower valued or more cheaply valued companies, which is exactly the pattern we saw today after the minutes were released.
Brian, you mentioned Omicron, and the market is seeing its way through this pandemic variant at this point. You can see it around some of the bets that have been placed. Is that going to be the same story for the Fed? Because it feels as though it's reached its 2% mandate on inflation, and perhaps we're getting closer to full employment as well, given the change in structure we've seen in the workforce. Do you think Omicron is going to make that much of a difference this year for Fed policy?
I think it could put the Fed in an awkward position. Right now, the markets have a better than even chance priced in that the Fed will be raising interest rates in March. If the January payroll report is negative for payroll growth, as it was around this time last year when we were experiencing another wave of COVID, even if it looks like we're coming out of it, it'll be awkward for the Fed to be raising interest rates much sooner than expected just a few months ago in light of a weak payroll report that I think potentially is going to be coming our way in early February for the month we're in. I think the Friday report could be quite strong, but once the Omicron variant is felt on the impact of the labor force, the willingness for people to seek jobs, to people to hire workers in this environment, I think it could put the Fed in a bit of an awkward position and force them to punt this out a little bit further.
Brian, very good morning to you. Happy New Year, my friend. Look, I almost shed a tear for those hedge funds the other day when I heard that their average performance in 2021 was a mere 7 or 8% compared to the S&P, which put on 27% as well. And the reason why is being cited, they just didn't own enough of those massive stocks that powered the S&P higher as well. What about those massive stocks? If we see a rotation out of them now that is meaningful rather than just 1 or 2 days, that could spell very, very big problems for the broader market, couldn't it?
I think what investors probably should focus on as we're kind of still looking back at 2021 is that U.S. large cap growth stocks, which continued to lead last year, very familiar place at the top of the distribution of asset class returns, are unlikely to continue to be dominant this year. That was our thesis coming in, even before we knew about the Fed's hawkish pivot all the way back in November when we released our report for this year. We were focused on areas that underperformed last year, U.S. small cap stocks, which seem extremely cheaply valued, Eurozone stocks, cyclicals within the US. So a much more kind of broad array of economically sensitive, but not overly expensive looking areas of the market. This week, I think, has validated that much more quickly than we would have anticipated. But if you're focused on industrials, you're focused on financials, I think even the pocket here for energy to outperform, I think that's very real. And we've seen it in the past. I think tech is going to have its day as a very high earning sector. But when the investors are focused on concerns about rising rates, it tends to perform less well. And I think that's where the focus is going to be for the near term.